It's great to have you back in. Thank you.
Thanks for having me.
I want to talk about your note over the weekend, but just since we're talking about Fed independence, what worries do you have about how far the president might push this?
Well, the main worry is that when you take your finance textbook out, the most important variable is the risk-free asset. Everything is priced off the risk-free asset. So if we're now having questions about, is there independence, is the risk-free asset really risk-free? That is, of course, opening a lot of debates across literally all financial markets around the world. So, of course, this is a very, very important discussion.
Have you begun to model what it might do to rates, at least?
Given that a lot of derivatives in notional terms are into the trillions in terms of priced off collateral in treasuries, it would, of course, have very, very serious implications if there were anything to happen to the market questioning whether we have a risk-free asset or not. So I do not believe that we have any questions about exceptionalism in the U.S. The U.S. is still the most dynamic economy in the world, still the most innovative economy in the world, still the largest capital market, still the largest military. For all these checkpoints on the reserve currency questionnaire, it still is the case that the U.S. is by far, of course, the most important and the most dominant currency in the world. Yes, there may be some issues with the trade war having some impact and issues around what the implications could be in the near term for the business cycle, but the long-run outlook for the U.S. economy is still very strong.
That said, your note over the weekend refers to what you're calling the voluntary trade reset recession, right? In which you sort of delineate all the consecutive challenges that the economy is potentially going to bear. Right?
Yeah, because the issue is that tariffs of this magnitude on China is having a very significant impact on small businesses. Large businesses can pay the extra cost because when goods come from China to Los Angeles, then, of course, you have to pay now a higher tariff. Large companies have the resources and the working capital to deal with that. But small businesses do not have the working capital. So think about your independent toy seller in Nebraska, your men's clothing wearer in Wyoming. Think about your Colorado seller of ski gear. They basically do not have money and cash to pay 145% extra. So we will have bankruptcies of retailers of very significant magnitudes if this is allowed to continue. Remember, retail employment is about 6 million workers. So in total, small businesses make up 80% of total employment, meaning in companies of less than 500 workers, and they make up 80% of CapEx. So we spend too much time talking about this in P 500. It really is the small businesses that are the most negatively impacted as a result of this. So yes, there may have been some front loading of purchases among consumers last weekend in Costco and Walmart. Everyone was shopping before the tariffs. But as that effect starts to fade, we will begin to see a serious negative hit on the economy if these tariffs stay in place.
So the jobless claims chart that I showed, showing that everything is just fine now, you expect that to change, it sounds like, very materially.
Because absolutely, Sarah, because I think that consumers are simply not aware of how serious this situation is. Companies are very much aware of it, especially small businesses. Anyone, of course, who knows a small business owner, in particular someone, of course, who touches anything on China. Remember, sellers on Amazon, they source 70% of their goods from China. So that means that if 70% of sellers on Amazon get goods from China, that's a very significant impact, not only on inflation, as we just talked about, but also the impact that eventually will have on the labor market.
So do you agree with the president that the Fed should preemptively cut?
Well, so the Fed is, of course, caught in this difficult situation that rates are going, of course, at the moment sideways, but inflation going up says the Fed should be hiking. GDP slowing down says the Fed should be cutting. So which one is it? What are they going to put weight on? And that's why the dual mandate and how they put the weight on the dual mandate.
That's why it's impossible for them to do anything now, right?
That's why Jay Powell is exactly saying last Friday, we can't really respond to this difficult situation, especially not when quantifications of tariffs at the current level will increase inflation over the next 12 months of around 1 percentage point. So that means that not only do we already have inflation above the 2% target, as your chart was showing, but we also have another percentage point on top of that coming in the pipeline. It's really difficult for the Fed to go and cut rates in that environment.
Back to sort of the idea of, a recession, I guess, perhaps business-led. A lot of small businesses sell goods and services to big business. So when big business is cutting back, it still has a huge impact on small business as well.
Absolutely, David. And also a very important statistic from the census is that 40% of imports from China go to small businesses. And also another 40% of imports from China go to intermediate goods. So when we build Boeing airplanes, F-150s, a lot of the components, namely 50% of an F-150 comes from abroad, and roughly a third of a Boeing airplane comes from abroad. So yes, some of this may be Canada and Mexico, but the impact of tariffs, especially on China, is still weighing heavily, in particular on small businesses. And we have not seen that in jobless claims yet, but we should expect to see that. It may take a little while longer because, again, of the front loading of purchases among consumers, but it's very clear among small businesses the situation is very serious.
So you think, where are you on growth this year for the U.S., given what you're talking about?
So it's all conditioned on tariffs staying in place at these levels, and if they stay at these levels, we will absolutely have a recession in 2025.
And you think GDP suffers, what, 4 points?
So this would be the calculation back to the academic papers who tried to quantify the trade war in 2018-19, found that for 1 percentage point increase in the average tariff rate for the U.S., which were up from 2% to 3%, it lowered GDP in the lowest estimate by a quarter. So now we raised the average tariff rate from the 3% up to 18%. So now we can multiply that by 15. That means that you get a number, in very round numbers, around 4 percentage points. And adding on top of that, all the other things that are headwinds to outlook, namely corporate confidence is low, consumer confidence is low. We just had a negative wealth effect because of the stock market down 6 trillion. Is also on its own, we would be talking about this having a negative impact on consumers. So combining these headwinds, absolutely the risks are to the downside.
You throw tourism in there as well?
Tourism also, because bookings from Canadians into the U.S. are down 70%. If you look at the top 10 airports, daily arrivals also down significantly in the last few weeks. So the list of things that make you worried about the outlook is unfortunately quite long.